The Great Depression, a massive downturn in the early 20th century. It caused starvation, economic collapse, and paved the way for fascism. One country has outsized responsibility for the depression, and yet they've escaped blame. That ends today. After the devastation of World War I, European nations pieced their economies back together. Part of that is returning to the gold standard. Okay, now we need to do a little math to explain what happened with our villainous country. By the way, I will not reveal that country until the end to maintain the mystery and also keep the view time high to please the algorithm. But I have simplified the math and I've hired a mime to help explain. He'll be here this entire video, and together we'll finally hold this nefarious country accountable. Okay, here's how the gold standard works. Each country sets their exchange rate. Say in America, it's $1 for 1 ounce of gold. That means at any time I can go to the government and say, I want gold for this, and they have to give it to me. The paper money is just a stand-in for gold. That's rule 1 of the gold standard. So countries go back on the gold standard and they get to choose their exchange rate. They have carte blanche to put it wherever they want. The country that shall not yet be named goes back on the gold standard in 1928 and decides to give a lot of their currency. To make the numbers easy, let's say it's 4 for 1. We'll call their currency something random, like franc, named for my friend Frank, but with a C. Notice how every country on the gold standard is now linked together, because I can take $1, trade it for a gold ounce, then trade that for 4 francs. So the currencies are tied together because they both could be traded for gold. Now, sometimes this linkage of currency between countries creates opportunity. Let's say wine cost $1 in the United States and 1 franc in the country that shall not be named. So I have $1. I can buy 1 bottle of wine in the US, or I can take my dollar, exchange it for an ounce of gold, and then exchange that for 4 francs. A bottle of wine, remember, in the unnamed country costs 1 franc. So my 4 francs can buy 4 bottles of wine. I could take those back to the US and then sell them for $1 a piece, making $3 in profit. This is called arbitrage, which is a pretty boring word, so let's spice it up by calling it l'arbitrage. All right, so a lot of people start trading gold for francs to take advantage of l'arbitrage. The country that shall not be named's gold stock triples, and by 1932, this country had 2% of the global population, but 27% of the gold. All right, now here's rule number 2 of the gold standard. Keep your money and gold in sync. More gold, print more money. Less gold, remove money from circulation. Burn it, stick it in a croissant, hide it under a beret, whatever. Just make sure your gold to money ratio stays constant. Econ Nerds, yes, I know this is actually done through interest rates, but remember, I'm keeping things super simple. We're not trying to build the Eiffel Tower here. Okay, so our unnamed country gets all this gold, and here's what should have happened. They should have printed a ton of money. When you print money, you have more money chasing the same goods, so prices go up. That's inflation. In the case of our example, wine prices would have risen to around 4 francs, so now the price between countries are even. Wine costs $1 or 1 ounce of gold in the US, and it costs 4 francs or 1 ounce of gold in the unnamed country. L'arbitrage is légal. This is how it's supposed to work. But our mystery country refused to print money. And so more and more gold keeps coming in, and they just store it. No money printing happens concurrent with all that gold. Other countries complain, but this country says, c'est la vie. They think the gold flows represent faith in their country, that their country has a certain je ne sais quoi about it. But now what happens? Other countries are losing gold, so they have to get rid of some of their paper money. So in those countries, we now have less money chasing the same amount of goods, making prices go down. This is deflation. So now wine goes from $1 to $0.25 in the US. At that low price, prices have been equalized between the US and the country that shall not be named. An ounce of gold buys 4 wines in both places. L'arbitrage, bon voyage. But notice, because the unnamed country wouldn't print more money, this happened through money destruction, deflation. And this is exactly what occurred in the late 1920s and early 1930s. Because our masked country refused to print money, they put downward pressure on global prices. They committed the faux pas of breaking Rule 2, and everyone else had to deal with it. It's as if they refused to wear deodorant, and the rest of the world had to plug their noses. So what's the issue with prices going down? Isn't that great? Low prices, ooh la la, right? Well, remember, wages are prices, the price for labor. So yes, things are cheaper, but my paycheck is smaller, and my existing debts, they don't shrink when prices go down. So I'm getting paid less, but I still owe the same amount of dollars. And people have a lot of debts. Farms and businesses take out loans to finance their operations. So this deflation triggers loan default and business failures. Deflation can be just as bad as inflation. Also, there's this big stock market crash in 1929. People get scared, there's mass ennui, and everyone stops spending. Now, what should the government do in that situation? Well, they should print money and voila, the economy would get moving again. But whoops, the government can't because we're on the gold standard. In fact, they have to do the opposite. They have to remove money from circulation because our villainous country keeps taking their gold. And remember, all the countries are linked, so this deflation and depression gets transmitted around the world. Eventually, countries give up and leave the gold standard, and it's only then that they start to recover from the depression. Economist Doug Irwin estimates that 40% of the decline in prices from 1930 to 1931 can be blamed on our unnamed country. So while the Great Depression has many causes, the gold hoarding of this country is definitely a driver, and yet they've dodged blame. Why? Well, maybe the Maginot Line that is math and monetary policy has obscured their role. Maybe people just like this country. I mean, it has fashion, romance, art, nice cafes everywhere. Maybe there's some sort of grand conspiracy to keep it quiet. But it'd be hard to keep all the conspirators silent, so probably not. Anyway, we've reached the end of the video. Our country's rendezvous with justice is now. The country in question is